Let me ask you a very simple question. If most of the professional fund managers fail to beat the market, then why as retail investors do we believe that we can consistently do better? In India today, we are flooded with so much of information, right? We have telegram groups, we have stock tips, we have sure shot multi-bagger reels, right? Yet, when you look at the real data or real facts and figures, the story is very, very different. So that is why in this video, I want to explain to you why index fund investing may be the best thing for you if you are a busy professional who has limited time, limited resources, and who wants to look at, a long-term investment prospect. Let's start with some facts and not just opinions. According to S&P Index versus Active reports, okay, more than 60 to 70% of actively managed large cap mutual funds fail to beat Nifty 50. Okay, and this is only just for a period of 5 to 10 years. If the investment duration is more than that, like 15 to 20 years, then this percentage is actually greater than 80%. Now, why does this happen? This happens because markets are competitive. Okay, information is very quickly priced in, and the fund managers are actually looking at changing funds, monitoring the market, timing the market, and all of these can result in not beating the market eventually. On the other hand, an index fund can actually help you do better because there is no stock price monitoring. You're not monitoring anything, you're just monitoring the market. Okay, you're not timing the market, you're not picking stocks, no prediction, no fund manager related risk. Now let's talk about something that investors like you and me most often just ignore. It is expense ratio. For a typically actively managed mutual fund or any other hedge fund, an expense ratio can be about 1.5 to 3%. On the other hand, for an index fund it will be about 0.1 to 0.3%. The difference may seem small now, but over the years, if you are investing say for over 25 years or 30 years, this will cost you in lakhs or even in crores. So for example, if you're investing 10,000 rupees for a period of about 25 years, every month you're investing 10,000 rupees, then this will actually reduce your corpus by 25 to 30%. On top of that, index fund also has some behavioral advantage. The simplicity of behavior actually wins over the longer term. How? Most investors don't lose money because we invest in bad funds. We lose money because of bad investing behavior. Okay, what we do is we panic sell during crashes, we stop SIPs during our bear markets, or we keep chasing top performing funds. So all of these decision fatigue is removed when it comes to index fund investing. You just keep investing regularly, consistently, and let compounding do its job. So India is a growing economy. Okay, we have rising middle class population, we have amazing digital adoption rate, and then our manufacturing and services sectors are also expanding. So when you invest in a broad index fund, you automatically end up investing in all the important sectors, be it FMCG, be it IT, be it services, etc., right, or banks. And when the leaders in each of these sectors change, the index fund adjusts itself. You don't have to do anything. And this is the reason why index funds are ideal if you're looking for a long term wealth creation, if you're a very busy professional who cannot give time to pick and choose stocks and invest at the right time and then withdraw at the right time, right? And you don't have to track markets, and you just have to believe that in the fact that India is a growing economy, and as the economy will grow, your index will grow and your wealth will grow as well.